Welcome to our deep dive into interest rates and inflation, two powerful forces that shape our everyday lives and the broader economy. Whether you're a student, a professional, or simply curious about how the economy works, understanding these concepts is essential. In this video, we'll break down what interest rates and inflation are, how they interact, and why they matter to you. Let's start by setting the stage with some basic definitions before exploring their real-world impact. Interest rates are essentially the cost of borrowing money or the reward for saving it. When you take out a loan, you pay interest to the lender. Conversely, when you deposit money in a savings account, the bank pays you interest. Central banks like the Federal Reserve set benchmark interest rates that influence the rates offered by commercial banks. These rates play a crucial role in economic activity, affecting everything from mortgages to business investment. Inflation refers to the general increase in prices over time, meaning your money buys less than it did before. It's measured by tracking the price changes of a basket of goods and services. A moderate level of inflation is normal in a growing economy, but high inflation can erode purchasing power and savings. On the other hand, deflation or falling prices can also be problematic, leading to reduced spending and economic slowdown. Central banks are key players in managing both interest rates and inflation. By adjusting policy rates, they aim to keep inflation within a target range, usually around 2%. When inflation rises too quickly, central banks may increase interest rates to cool down the economy. Conversely, if inflation is too low or the economy is sluggish, they might lower rates to encourage borrowing and spending. Interest rates have a direct impact on your daily life. When rates are high, borrowing becomes more expensive, affecting loans, mortgages, and credit cards. This can lead to higher monthly payments and may discourage big purchases. On the flip side, savers benefit from higher interest rates, earning more on their deposits. Understanding these effects can help you make smarter financial decisions. Inflation slowly erodes the value of money. As prices rise, the same amount of cash buys fewer goods and services. This is why people often notice their grocery bills creeping up over time. Even small increases in inflation can add up, making it important to consider inflation when planning for the future, especially for long-term savings and retirement. Interest rates and inflation are closely linked. When inflation rises, central banks often respond by raising interest rates to slow down spending and borrowing. This helps bring inflation back under control. Conversely, if inflation is low, rates may be cut to encourage economic activity. This balancing act is central to monetary policy and economic stability. Central banks aim for stable, low inflation because it creates a predictable environment for consumers and businesses. When inflation is stable, people can plan for the future with more confidence. High or unpredictable inflation, on the other hand, can disrupt spending, investment, and economic growth. That's why keeping inflation in check is a top priority for policymakers. Inflation is typically measured using indexes like the Consumer Price Index (CPI), which tracks the prices of a basket of common goods and services. By comparing the cost of this basket over time, economists can gauge how quickly prices are rising. This data helps central banks and governments make informed decisions about monetary policy. Interest rates can be short-term or long-term. Short-term rates are often set by central banks and influence things like credit cards and adjustable-rate loans. Long-term rates, such as those for mortgages or bonds, are shaped by market forces and expectations about future inflation. Both types play important roles in the economy and affect different aspects of financial planning. Mortgage rates are closely tied to interest rates. When central banks raise rates, mortgage rates usually follow, making home loans more expensive. This can slow down the housing market as fewer people can afford to buy homes. Conversely, lower rates make mortgages cheaper, often boosting home sales and construction activity. Businesses also pay close attention to interest rates. When borrowing costs are low, companies are more likely to invest in new projects, hire workers, or expand operations. High interest rates, however, can make borrowing more expensive, leading businesses to delay or scale back their plans. This, in turn, affects job creation and economic growth. Interest rates also influence how people save and invest. Higher rates mean better returns on savings accounts and fixed-income investments like bonds. When rates are low, people may seek higher returns in stocks or real estate. Understanding this relationship can help you make better choices for your financial future. Inflation doesn't just affect prices, it also impacts wages. If prices rise faster than wages, workers may feel like they're falling behind, even if their paychecks are growing. Ideally, wage growth keeps pace with inflation, helping maintain purchasing power. This balance is important for overall economic well-being. Interest rates and inflation aren't just local issues, they have global effects. Changes in major economies like the US can influence rates and inflation worldwide. For example, when the Federal Reserve raises rates, it can impact currency values, trade, and investment flows across the globe. Interest rates play a big role in currency exchange rates. Higher rates tend to attract foreign investors looking for better returns, which can strengthen a country's currency. Conversely, lower rates may weaken the currency. Inflation also matters. Countries with high inflation often see their currencies lose value over time. Expectations about future inflation and interest rates can influence behavior today. If people expect prices to rise, they may spend more now, which can actually drive inflation higher. Similarly, if businesses expect rates to rise, they might borrow or invest sooner. Central banks pay close attention to these expectations when setting policy. It's important to distinguish between nominal and real interest rates. The nominal rate is the stated rate you see, while the real rate adjusts for inflation. For example, if a savings account pays 3% interest but inflation is 2%, the real return is only 1%. Understanding this difference helps you make better financial decisions. Inflation can actually help borrowers. If you have a fixed-rate loan, rising prices mean you're repaying your debt with money that's worth less over time. However, lenders lose out as the real value of repayments falls. This is why lenders often charge higher interest rates when they expect inflation to rise. While moderate inflation is normal, hyperinflation is a rare but serious problem. In cases of hyperinflation, prices rise uncontrollably and money loses value rapidly. This can devastate economies, wipe out savings, and make everyday transactions difficult. Central banks work hard to prevent such scenarios through careful policy. Deflation, or falling prices, might sound good, but it can be harmful. When prices drop, people may delay purchases expecting things to get cheaper. This reduces demand, slows economic growth, and can lead to job losses. Central banks often lower interest rates to combat deflation and encourage spending. Stagflation is a rare situation where high inflation and high unemployment occur together. This is challenging for policymakers because traditional tools like raising or lowering interest rates may not work as expected. Stagflation requires careful, targeted solutions to restore economic balance. Phillips curve is an economic concept that describes an inverse relationship between unemployment and inflation. In theory, as unemployment falls, inflation rises and vice versa. However, this relationship doesn't always hold, especially during periods of stagflation or when other factors are at play. Quantitative easing is a tool used by central banks to stimulate the economy when interest rates are already very low. By buying government bonds and other assets, central banks inject money into the economy, aiming to boost spending and investment. This can help fight deflation but may also risk higher inflation if not managed carefully. Many central banks use inflation targeting as a strategy. They publicly announce an inflation goal, usually around 2%, and adjust policy tools to achieve it. This approach helps anchor expectations and provides transparency, making it easier for businesses and consumers to plan for the future. Fisher effect is an economic theory that describes the relationship between nominal interest rates, real interest rates, and expected inflation. According to this theory, nominal rates move in line with expected inflation, so real returns remain stable over time. This concept helps explain why lenders demand higher rates when inflation is expected to rise. Stock markets are sensitive to changes in interest rates. When rates rise, borrowing costs increase and future profits are discounted more heavily, which can lead to lower stock prices. Conversely, lower rates often boost stock markets as companies can borrow cheaply and investors seek higher returns in equities. To guard against inflation, some investors choose inflation-protected securities like Treasury Inflation-Protected Securities (TIPS). These investments adjust their value with inflation, helping preserve purchasing power. They're a useful tool for long-term savers concerned about rising prices. In recent years, both interest rates and inflation have seen significant shifts. Factors like the global pandemic, supply chain disruptions, and government stimulus have all played a role. Central banks have responded with a mix of rate changes and unconventional policies to keep economies stable. As we look to the future, interest rates and inflation will continue to play a central role in economic policy and personal finance. Staying informed about these topics can help you make better decisions, whether you're saving, investing, or planning for major life events. Thanks for joining us on this journey through the world of interest rates and inflation.